Welcome to this morning's infopod from Politica UK. Oil shock, how the Iran war is shaking the global economy. No country will escape the shockwaves. Global markets were hit hard this morning as the Iran war pushed oil sharply higher. Reuters reported Brent crude around $190.50 a barrel after a roughly 25% one-day surge, with WTI also jumping sharply. Reuters described it as the biggest single-day oil move in decades, driven by fears of supply disruption, producer cutbacks in the Gulf, and damage to routes linked to the Strait of Hormuz. The immediate market message is simple. Investors are no longer pricing this as a short scare. They are pricing in the possibility of a prolonged energy shock. That is why stock markets have fallen while the dollar has strengthened. AP reported steep losses across Asia this morning, with Japan's Nikkei down more than 5%. South Korea's Kospi down 6%, and Taiwan also sharply lower. Reuters said bond yields have risen and markets are scaling back hopes for early interest rate cuts because high oil means fresh inflation pressure. So what do these figures actually mean? First, they mean inflation risk is back. When oil jumps this fast, it does not stay confined to petrol stations. It feeds into shipping, aviation, chemicals, plastics, food production, and household energy bills. Reuters said wheat, corn, palm oil, soybean oil, and aluminium all moved higher as traders priced in wider supply and transport stress. Second, they mean central banks have a new problem. Only days ago, many markets were thinking about weaker growth and possible rate cuts. Now policymakers are staring at the risk of stagflation, slow growth but rising prices. Reuters said the Iran shock is forcing a sharp policy rethink, especially in Asia, because cutting rates into an oil spike can weaken currencies and worsen imported inflation. For the United States, the picture is mixed. America is still a major oil producer, so high crude can support parts of the domestic energy sector. But for consumers and the broader economy, the effect is still painful. Higher petrol prices, more inflation pressure, and less room for the Federal Reserve to ease. Reuters also noted that the dollar has been strengthening as investors seek liquidity and as inflation fears push rate cut expectations further out. For Europe, this is bad news. Europe is one of the major economies most exposed to imported energy shocks. Reuters said the Eurozone is particularly vulnerable because the region has only modest growth to begin with, so another energy spike hits households, industry, and confidence at the same time. In plain English, Europe gets squeezed from both sides, higher prices and weaker growth. For the United Kingdom, it means dearer fuel, stickier inflation, and more pressure on households and businesses. Britain is not as exposed as some Asian importers, but it is still deeply affected by global oil and gas prices. In market terms, the UK reads this as another imported inflation shock, which complicates any hope that borrowing costs can fall quickly. That is not a separate British crisis yet, but it is certainly not good news. This follows the broader global inflation shock Reuters described this morning. For Japan, this is serious. Reuters reports that Tokyo is already considering measures to cushion the economy, including possible use of oil reserves, and senior politicians are openly arguing for fuller use of nuclear power to reduce dependence on expensive imported fuel. Japan is highly reliant on imported energy, so a war-driven oil spike quickly becomes a national economic issue, not just a market headline. For South Korea, the shock is even more immediate. Reuters says Seoul is imposing a domestic fuel price cap for the first time in nearly 30 years, while also looking at broader market stabilization measures. South Korea buys a large share of its oil from the Middle East, so when crude surges and the won weakens, the pain arrives fast through fuel, transport, and import costs. For India, the numbers are ugly. Reuters described India as the world's third largest oil importer and said higher crude is clouding the economic outlook by raising import costs and worsening inflation and growth worries at the same time. That is why Indian shares fell sharply this morning. India is exactly the sort of economy that suffers when energy prices jump before incomes have a chance to adjust. For China, the picture is more complicated. China imports huge volumes of oil, so in theory it is exposed. But Reuters has noted that China went into this period with strong crude inventories after buying discounted Russian and Iranian barrels, which leaves it better positioned than many other importers in the short term. That does not mean China is comfortable. It means Beijing has a buffer. In a crisis, buffers matter. For the Gulf states, there is a split between governments and markets. Higher oil should, in theory, support oil exporting countries. But local stock markets in the UAE still fell sharply this morning because investors are focused not just on prices, but on disruption, flight risks, business interruption, and regional instability. Reuters said Dubai's main index dropped 3.6% and Abu Dhabi's 1.6%, even as crude surged. That tells you markets are seeing war risk, not just export upside. For airlines and travel, the message is brutal. Reuters said airline shares have been battered as fuel costs spike and regional disruption worsens. When oil rises this fast, airlines are among the first sectors to feel it because fuel is such a large part of operating costs. So when you see airline shares falling, that is the market telling you this is not just an oil story, it is a broader economic shock story. And for ordinary people, these figures mean something very practical. They mean the risk of more expensive petrol, pricier flights, higher food costs, more pressure on household bills, and renewed inflation, just as many countries were hoping to move past the worst of it. Reuters says governments across Asia are already scrambling with reserve plans, tariff cuts, price caps, and emergency measures. That is what happens when markets stop treating a war as distant and start treating it as economically contagious. So the deeper meaning of this morning's markets is not simply that oil is up. It is that the Iran war has moved from a geopolitical crisis into a global economic one. And once that happens, every country starts to ask the same question, not just how long the war will last, but how long their economy can absorb the shock. This infopod was brought to you by Politica UK.